While the world was busy celebrating what looked like a historic breakout in silver, something far more important was unfolding quietly behind the curtain. This was not normal trading behavior, and it certainly was not simple volatility. It was a stress reaction inside the financial system itself. Late at night, when liquidity is thin and public attention disappears, emergency decisions were made that would fundamentally alter the battlefield. The price action had crossed a psychological and mathematical threshold, and models that usually comfort institutions were suddenly flashing danger. That moment forced the system to reveal its true character. It faced a simple but uncomfortable choice: accept losses created by a free market or intervene to preserve those who were never meant to lose. What followed was not announced, debated, or explained. It simply appeared quietly with immediate consequences. Margin requirements were raised sharply, not in response to falling prices or rising risk, but during strength. That distinction matters. In any genuine market, rising prices reward conviction. Here they triggered punishment. This is the moment every serious investor must understand. Leverage is not just a tool, it is a leash. When conditions are stable, it feels invisible. When conditions turn against large players, it tightens instantly. Imagine committing capital under one contract only to be told mid-game that the cost of participation has doubled overnight. No new information, no warning, just comply or liquidate. That is not risk management, it is forced behavior. Thousands of participants woke up not to losses but to demands. Not because they were wrong, but because the rules had shifted. This is how pressure is manufactured. When selling is encouraged and buying is discouraged, prices stop discovering truth and start reflecting control. And when this happens during a breakout, it signals something critical. The move was real enough to scare those on the other side. This chapter is not about emotion, it is about structure. Because when systems reveal how they defend themselves, they also reveal where they are weakest. Type 1 to continue to Chapter 2. Type 2 to stop here. And if you want this analysis to continue, subscribe and leave a 1 in the comments. To understand why this kind of intervention matters, you first have to understand how leverage actually functions inside modern markets. Futures trading is not built on ownership, it is built on confidence. You post a fraction of the total value as a margin, trusting that the rules governing that contract will remain stable. That trust is the foundation of participation. Under normal conditions, margin exists to protect the system from volatility. When prices move violently against a position, margin increases act as a buffer, but when margin is raised into strength, it serves a completely different purpose. It is no longer about managing risk, it is about managing behavior. When margin requirements double overnight, capital is drained instantly. Traders are forced to make a decision that has nothing to do with market direction. They must either inject new cash immediately or exit positions they may still believe in. This is not a reflection of being wrong, it is a reflection of being outmaneuvered. Think about the psychological impact. A trader who correctly identified a breakout suddenly finds themselves punished for being early. Confidence erodes not because the thesis failed, but because the environment changed. This is how strong hands are turned into weak hands without ever touching the price directly. This mechanism creates artificial selling pressure. Positions are liquidated not because demand disappears, but because access to capital is restricted. The chart may show selling, but the cause is structural, not organic. That distinction separates real market signals from manufactured ones. What makes this more dangerous is timing. These actions occur when retail participation increases and momentum accelerates. That is not coincidence. It is the moment when leverage shifts from empowering participants to controlling them. This is why seasoned investors focus less on headlines and more on rule changes. Price tells you what happened. Rules tell you what is allowed to happen next. And when the rules change abruptly, it usually means someone important is losing. The market is not just a place where prices move, it is a system of incentives. When those incentives are altered mid-cycle, the outcome becomes less about discovery and more about survival. Understanding that difference is the first step toward navigating what comes next. When direct pressure fails to achieve the desired effect, markets often shift from mechanical control to psychological influence. This is where perception becomes more powerful than price. Investors are not only reacting to numbers on a screen, they are reacting to what they believe other participants are about to do. One of the most effective tools in this phase is the illusion of overwhelming supply. Large sell orders appear suddenly stacked above the market, creating the impression that any upward movement will be crushed instantly. To an untrained eye, this looks like resistance. To an experienced observer, it looks like theater. These massive orders rarely represent genuine intent. They exist to shape behavior, not to execute trades. They appear long enough to trigger hesitation, fear, and second-guessing, then vanish before being filled. The goal is simple. Convince buyers they are alone, convince holders that everyone else is rushing for the exit. This tactic works because markets are social systems. Most participants do not want to be last. When fear replaces analysis, positions are abandoned, not because fundamentals changed, but because confidence collapsed. That is how momentum is reversed, without real selling pressure. At the same time, access is subtly restricted. Trading platforms begin displaying warnings, limitations, or sudden errors. Buying becomes difficult while selling remains easy. This asymmetry matters. When one side of the transaction is constrained, price movement stops reflecting true demand. What emerges is a distorted signal. Charts begin to tell a story that does not match reality on the ground. The market appears weak, yet interest remains high. This disconnect is where many investors lose their footing, mistaking engineered hesitation for genuine reversal. History shows that these phases often occur near inflection points. They are attempts to exhaust conviction rather than disprove a thesis. When fundamentals remain intact, but sentiment is shaken, the battle shifts from analysis to endurance. The key lesson here is awareness. Not every barrier is real. Not every move against you is a verdict on your idea. Sometimes it is simply a test of patience designed to separate those who react from those who understand what is happening beneath the surface. To fully grasp the implications of what is happening, we need to look beyond individual trades and examine the role of the exchange itself. An exchange is meant to function as a neutral infrastructure, a referee that enforces rules consistently and transparently. Its legitimacy depends entirely on trust. When that trust is compromised, the market it supports begins to fracture. Rule changes made during moments of stress, especially those that disproportionately affect one side of the trade, raise serious questions about alignment and incentives. The issue is not whether exchanges are allowed to manage risk. The issue is who that risk management ultimately serves. Governance matters. When decision-makers share close professional or financial ties with dominant market participants, neutrality becomes difficult to maintain. Even the appearance of favoritism can undermine confidence. Markets rely on the belief that outcomes are determined by supply and demand, not by relationships. Once participants suspect the field is tilted, behavior changes. Hedgers hesitate. Speculators reduce exposure. Long-term planners seek alternatives. The market may continue to function, but it no longer commands respect. It becomes a venue of last resort rather than a center of discovery. History provides clear parallels. Periods where exchanges intervened aggressively to protect stability often succeeded in the short term, but at the cost of long-term credibility. Participants remember when the rules changed against them. That memory does not fade quickly. What we are witnessing is not just volatility, but institutional risk. The more frequently rules are adjusted under pressure, the more participants begin to price that uncertainty into their decisions. Liquidity becomes fragile. Confidence becomes conditional. At this stage, the damage is often invisible. Volumes may persist, prices may stabilize, but the foundation is weakened. Once trust erodes, it rarely returns all at once. It dissipates gradually, then suddenly. Understanding this dynamic is essential. Markets do not collapse only because prices fall. They collapse when participants no longer believe the process is fair. When that belief breaks, capital does not argue. It simply leaves. When confidence in the process begins to fade, attention naturally shifts from paper representations to physical reality. This is where price discovery reveals its limits. A quoted price only matters if delivery is reliable. When access to the underlying asset becomes uncertain, the number on the screen loses authority. The most telling signal in moments like these is the divergence between paper pricing and real-world availability. Investors may see a stable or declining quote, yet face rising costs when attempting to acquire the actual asset. Premiums expand, inventories thin, and delivery times stretch. These are not anomalies, they are symptoms. This separation exposes a critical truth. Paper markets trade promises not material. As long as those promises are believed, the system functions. Once doubt enters, behavior changes quickly. Participants begin asking not what the price is, but whether the asset can be obtained at that price. This shift alters incentives across the entire chain. Dealers become cautious. End users secure supply earlier than planned. Producers reconsider forward commitments. The market starts operating on parallel tracks, one driven by contracts, the other by necessity. Historically, this kind of bifurcation does not resolve quietly. Either confidence is restored through transparency and delivery, or the paper price is forced to adjust upward to reflect scarcity. There is no stable middle ground. What makes this phase particularly powerful is that it removes emotion from the equation. A manufacturer does not care about narratives or sentiment. If an input is unavailable, production stops. When industrial demand meets constrained supply, theoretical pricing models lose relevance. This is why physical markets often lead paper markets at turning points. They respond first without leverage, without margin, without the ability to defer reality. Once the physical side tightens, the paper side must eventually follow, regardless of rule changes or temporary pressure. At this stage, the question facing participants is no longer about timing a trade. It is about understanding where true price discovery ultimately occurs. As stress builds within the system, contingency clauses that once seemed irrelevant begin to matter. Deep inside exchange agreements are provisions designed for extreme circumstances, moments when normal operations are no longer possible. These clauses exist to protect the institution, not the participant. When supply tightens and delivery becomes uncertain, the definition of an emergency can expand quickly. Settlement mechanisms may shift from physical fulfillment to cash equivalents justified as stability measures. On paper, this appears orderly. In practice, it transforms ownership into compensation. This distinction is critical. A cash settlement satisfies a contract, but it does not satisfy demand. It converts a claim on a scarce resource into exposure to a currency system already under pressure. For participants who entered the market to hedge physical need or preserve purchasing power, this outcome defeats the purpose entirely. The anticipation of such measures changes behavior in advance. Sophisticated participants begin reducing reliance on centralized venues. Direct agreements replace standardized contracts. The more these alternatives grow, the less relevant the original platform becomes. At the same time, narrative control intensifies. Public discussion shifts away from structural issues and towards surface-level explanations. Volatility is framed as speculation. Shortages are described as temporary. The goal is to maintain confidence long enough to manage exposure. But confidence cannot be manufactured indefinitely. When participants sense that contractual guarantees are conditional, trust erodes rapidly. Markets are built on expectations. Once those expectations are rewritten, participation declines. This phase often marks a turning point. Systems can absorb losses. They struggle to absorb disbelief. When participants no longer trust outcomes, they seek certainty elsewhere, even at higher cost. Understanding this risk is not about predicting exact timing. It is about recognizing incentives. Institutions will always act to preserve themselves first. Knowing where that line exists allows investors to position accordingly. As confidence weakens inside one system, pressure does not disappear. It relocates. Markets are global by nature, and when credibility erodes in one venue, participants quietly look elsewhere. Capital is pragmatic. It moves toward structures that feel more reliable even if they are less familiar. When pricing mechanisms lose trust, alternatives gain importance. Platforms that emphasize physical settlement and delivery begin to matter more than those built primarily on leverage. This shift rarely makes headlines, but it reshapes flows beneath the surface. In these environments, buying is driven less by short-term speculation and more by long-term strategy. Suppressed prices are interpreted not as signals to exit, but as opportunities to accumulate. What appears as weakness in one market becomes strength in another. This creates a dangerous feedback loop. Attempts to control price locally can accelerate the export of real assets globally. Once physical inventory moves offshore, it is not easily replaced. Strategic reserves are finite, and rebuilding them takes time. Industrial participants feel this pressure first. When traditional hedging tools become unreliable, companies seek direct supply relationships. Security of access outweighs marginal pricing advantages. Reliability becomes the new currency. This is how influence shifts in modern markets, not through dramatic confrontations, but through quiet reallocation. Liquidity follows trust. Power follows delivery. For investors, this stage requires a wider perspective. Short-term price movement matters less than structural direction. Understanding where confidence is forming and where it is dissolving becomes critical to navigating what comes next. As the pressure intensifies, something unexpected happens. Instead of discouraging participation, repeated interventions begin to harden conviction. What was once a trade starts to feel like a statement. Volatility, rather than scaring participants away, attracts attention to the underlying imbalance. When rules are changed repeatedly, investors stop assuming stability and start assuming interference. This changes psychology. Instead of reacting emotionally to price swings, participants begin interpreting them as signals of stress elsewhere in the system. Each intervention becomes confirmation that the structure is strained. This is the point where capital behavior shifts from passive to intentional. Participants reduce exposure to intermediaries and increase exposure to tangible assets. Risk is no longer defined by volatility but by counterparty reliability. Ownership becomes more important than liquidity. At the same time, collective awareness grows. Information spreads faster than institutions can control narratives. Discrepancies between official explanations and lived experience become obvious. When people see one price quoted and another paid, trust erodes quickly. This dynamic fuels a broader rethinking of value. Assets that cannot be diluted, paused, or redefined gain attention. The appeal is not speculation but durability. The desire is not profit at any cost but protection against uncertainty. History shows that movements like this rarely reverse quietly. Once participants internalize the idea that systems can change rules without notice, behavior adapts permanently. Trust, once lost, is not easily rebuilt. This stage is less about confrontation and more about alignment. Capital flows toward what feels real, dependable, and outside discretionary control. That shift may be slow, but it is powerful, and it tends to persist longer than most expect. As structural tension builds, hidden leverage becomes the silent accelerant. Not all risk is visible, and not all exposure is reported. Beneath the surface of official markets exists a network of off-balance sheet agreements, opaque contracts, and private arrangements that expand during periods of complacency and become dangerous during stress. When prices rise and volatility increases, the cost of maintaining these positions escalates rapidly. What once seemed manageable under stable conditions turns into a burden. Carrying costs increase, collateral demands rise, and flexibility disappears. This is where pressure compounds. The danger of hidden leverage is not its size alone, but its invisibility. Because it is not fully disclosed, it cannot be priced accurately by the market. When adjustment finally occurs, it does so suddenly. Liquidity evaporates, positions unwind aggressively. Confidence collapses faster than models anticipate. This is the anatomy of systemic shock. Not a gradual decline, but a sharp repricing driven by forced decisions. Institutions scramble to reduce exposure, at the same time amplifying moves that were once thought improbable. For participants watching closely, warning signs appear early. Unusual volatility, inconsistent pricing, and abrupt policy responses all point to strain beneath the surface. These are not random events, they are signals. At this stage, survival becomes the priority. Institutions protect the capital first. Reputation second. Markets become reactive, not predictive. Price stops leading reality and starts chasing it. Understanding this phase is crucial because it reframes risk entirely. The greatest danger is no longer being wrong about direction, but being trapped in a structure that cannot absorb stress. Those who recognize this early focus less on timing and more on positioning. At the end of every distorted cycle, clarity eventually returns, not because rules improve, but because reality asserts itself. Systems built on confidence can bend for a time, but they cannot override fundamentals indefinitely. When supply is constrained and demand is real, price ultimately follows. The lessons from this episode extend far beyond any single market. The first is structural awareness. Understanding how rules, leverage, and incentives interact is more important than predicting short-term price movement. Markets reward those who study architecture, not just charts. The second lesson is patience. Volatility is not evidence of failure. In many cases, it is the cost of exposure to truth while the system resists adjustment. Those who confuse turbulence with weakness often exit just as resolution approaches. Third, ownership matters. Assets that exist outside discretionary control behave differently under stress. They do not rely on permission liquidity windows or counterparties to maintain value. In uncertain environments, resilience becomes the defining feature. From a strategic perspective, diversification is no longer just about asset classes, but about systems. Exposure spread across different structures reduces reliance on any single set of rules. This is not pessimism, it is prudence. Finally,